Hello everyone, myself Deepak Gupta, logging on this platform of College Dekho Learn to undertake the topic fixed income securities valuation. So this is in continuation of our chapters on the topic investment management, where we have already discussed the valuation of variable income securities, that is equity, and now we are starting with the fixed income securities. So as you all know, primarily there are two kind of securities, that is the preference shares and the debentures, or we can say the debt, which assures fixed income to the investor. So in the case of preference shares, the preference equity shareholders are assured of a fixed dividend by the name preference dividend, when we will show it by the symbol PD here. So if they purchase preference shares of a particular company at the current market price, so if we denote that current market price as P0, then they are expecting the fixed dividend which has been assured by the company. And similarly, when or if they purchase the debentures of a particular company, it means they are providing debt to the business irrespective of its profitability, then they are expecting fixed interest known as I. So if they have purchased on the current market price, or we should say the face value, if the shares are purchased from the primary market, or they can be purchased on the available rate if such debentures are available for trading in the secondary market, then we can also use the word value of the bond. So normally, if the debentures are tradable in the secondary market, then instead of the word debentures, we tend to use the word bond. It is just the character of the instrument and nothing else. But by the logic, they will always be getting interest and they will be getting preference dividend on these two kind of fixed income securities. So before we move on, we have to understand the implications of income tax. So because if we understand that, then we will be able to smoothly cover their valuation and returns part. So what the point is that normally when a company generates revenue, so out of the revenue we have to deduct the operating expenses. And once these are deducted, we arrive at the figure of operating profit, commonly known as EBIT. Commonly known as EBIT. Now out of this EBIT, you have to deduct this interest, which is a fixed income return, or which is a fixed income on debentures or the bond. So the interest on debt, that is the I. And then we arrive at earning before tax, and then we have to pay the taxes to the government. So what is happening here, that once the taxes are paid, we arrive at the figure of profit after tax. So if a business pays interest on debt, then it reduces its taxable profit. So EBT in a way denotes the taxable profit, and hence we can say that this interest on debt saves the tax. So if we presume that the tax rate is denoted by the symbol small t, then whatever is the I, the tax which could have been paid on this will be saved. So I into T will be taxes saved on interest paid. So from the perspective of the company, this tax saving reduces the cost of the interest. So before we move on further, we understand that effectively this interest was the cost of debt funding for the company. But because of inherent tax savings, the effective cost of debt will be the interest I minus the tax saved, that is IT. So what we will be having, that the effective interest cost for the company will be I1 minus T, and whatever is the cost to the company they should be presumed as a return to the shareholders. So what it implies that companies, even if they pay interest at par with the preference dividend, but the resultant tax savings further reduces the cost in favor of the company, and hence this in a way supports the company to give higher interest or comparable interest to the financier, to the investor on debentures because of this tax saving. Why I am stressing on this? Because in this scenario, after we arrive at the figure of PAT, then we distribute dividend from here. So preference dividend brings no tax savings. So if a company is paying 10% preference dividend, and if a company is ready to pay 10% dividend, so for the investor, they both are at par, but from the company point of view, there is effectively a saving on the interest. So if the tax rate is 30%, so the effective cost of funding to the company will not be 10%, but it will be 7%. So this may prompt the companies to go for debt funding, which increases the demand for the debentures, and hence the investor is able to generate more and more of returns on its debentures. So if we keep this aside for the moment, we can say that this tax savings on interest on debentures tilts the favor tilts the balance, in favor of the debentures when it comes to a preferable investment security, if we are talking about the fixed income securities. So if I complete this, once we are paying PD, then we use the word earnings, and these are the earnings which are available for equity shareholders, and out of this some part is given as dividend to the shareholders. That denotes the cost of equity. Here it denotes the cost of preference, and this interest denotes the cost of debt, and the balance undistributed part is known as retained earnings. So why equity is not a fixed income security? Because how much of the earnings will be distributed as dividend is a choice with the management of the company, and that may differ with various circumstances. Hence, equity is not termed as a fixed income security, and that is why that their valuation is quite different from what we are going to study from here. So if you see this chart, you will see that the first and the foremost right of interest, which is payable out of the operating profit, and even if there is no profit, even then the interest is to be paid. So it may happen that the company expected profits, but there were no profits, or there were not sufficient profits to pay the interest on the debt, but still they are under a liability to pay interest, and it may not be the case with preference dividend, and it is definitely not a case with the equity. Therefore we say that debt is the least risky funding from the investor point of view, and vice versa from the company point of view, because from the company point of view they are at the highest risk, because they are under compulsion to pay interest on debt even if there are no sufficient profits. So what it implies from here is that from the cost point of view, KD is the least and KE is the highest, whereas cost of preference lies in between, because company is giving assurance to the debt holders to interest. So therefore they are having less risk, and if they are having less risk, then they expect less returns, and that is opposite the case with the equity, because they are not assured whether they will get the dividend or not. They are not assured whether they will get, or they how much amount they will get, and therefore they are taking highest risk in order of expectation that after paying the interest, taxes and the PD, earnings are still so high that the return on equity will be more than the return on debt on the return on the preference. So we can say that from this perspective, KD is the cheapest source and K is the most expensive source. So if I come to the heading of my topic, then we can say that though Debentures and preference are fixed income securities, but they normally are less, they provide less returns as compared to returns on equity. So, from the investor point of view, the fixed income securities, that is debt and preference. From the investor point of view, I'm again repeating, from the investor point of view, the debt and preference are low risk and low return investment options. So, what we are going to do in this series on fixed income securities is that whenever you are planning to buy any debt or preference, you will either try to expect the returns on such investment, or so that if you identify those returns, then you can match them with your expected returns. So what you expect, if it is less than the returns on the debentures or the preference, it means the investment option is giving returns more than what you anticipated. Then you make a choice about the acceptance of investment. Accept the investment. So one criteria of making an investment choice is by calculating the available returns on such fixed income option, and then you compare it with your expected returns, and if the available returns are more than what you anticipated, what you expected, then the investment must be made. And the another option here is regarding the valuation. The valuation as per expected returns. In this scenario, what will happen कि आप अपनी एक्सपेक्टेशन के हिसाब से कुछ फंडे यूज करके उस पर्टिकुलर इन्वेस्टमेंट ऑप्शन की, यानी कि डिबेंचर की या प्रेफरेंस कैपिटल, प्रेफरेंस इक्विटी शेयर की, प्रेफरेंस शेयर की सॉरी, आप वैल्यू डिसाइड करोगे दैट व्हाट शुड बी द इंट्रिंसिक वैल्यू ऑफ दैट इन्वेस्टमेंट. So that intrinsic value is actually denoting the value that ought to be in the market as per the investor's desired rate of return. And if this intrinsic value is less than the market price of the option of the security, then it means the security looks expensive and you will not go for the purchase. And if it is a vice versa case, that is the intrinsic value is more than the market value of the security, it means, so it denotes that the security is trading at discount to its intrinsic value. So we say it is a value buy, and because we term it as a value buy, so we go for accepting the investment. So we go for accepting the investment. So what is happening here? So what is happening here that you can choose either this funda or this funda. अगर मैं अपनी बात को समझाने के लिए थ्योरिटी की जगह एक एग्जांपल लेके चलूँ, that there is a bond, that is a kind of debenture available in the market. तो bond की face value if I say is 1000 and it is a 8% bond. It means it will give you returns of 8% each year. It means the interest per annum is rupees 80, and this bond is available in the market. That is the current price of the bond, if we say is rupees 980. So what is happening? A 1000 rupee bond is available at a discount of rupees 20 in the market. So on the first look, this bond looks attractive because it is trading at discount on the face value. But that is not the right approach, because whether we should be buying this bond or not depends upon our desired rate of return. Depends upon our desired rate of return. And in this case, we have ignored taxation because normally, in spite of our discussion, we presume that to compare the preference and the debt at par, we should be taking aside the benefit of taxation accruing to the debenture. So for this example, we're ignoring that, and therefore, if the desired rate of return is say 12% per annum, so this is the desired rate of return. So either we will calculate the intrinsic value, and if this intrinsic value is more than 980, it means it is a value by we will make the investment, or we will calculate the value of bond at the rate 12% returns. So by using the concept of time value of money, we will discount all returns at the rate 12%, which is the desired rate of return, and then we will arrive at the value. ठीक है? और what we could have done कि हम इस 980 के रिटर्न से अगर हमने 8% का रिटर्न कमाया, जिसकी कुछ टाइम के बाद मेच्योरिटी 1000 रुपीज़ है, तो यहाँ by the concept of, by the funda of IRR, we could have calculated the effective returns. And if these effective returns are more than 12%, only then we could have accepted the proposal. So how these two approaches will work in tandem or in choice, that we will be discussing on this later part of the either is this session or in the sessions to come. But before I move on, it is to be understood by all of you who are seeing this video that we have to consider preference and debentures as fixed income securities, though the nature of the return is either preference dividend or interest. Secondly, we can always make a choice of making the investment or not, either based on the intrinsic value or the effective rate of return. And in this both the cases, either we use the word effective rate of return, which is compared with the desired rate of return, or we calculate the intrinsic value and compare it with the actual current market price of the investment option. So, but whatever way we use, before we land into those calculations, we have to understand that these fixed income securities, they normally provide equal returns during their horizon of investment, but they can be termed two-way. One are irredeemable options. So we can say irredeemable debt or irredeemable preference capitals, and others can be redeemable. That is redeemable debt or preference capital. So as the word in itself suggests, that is redeemable and irredeemable. So they have been derived from the basic word redemption, which denotes paying back. It means when the company has arranged funds, it means company has sold. It means company has sold you the returns or the bonds. Just a moment. So again come back to where we were speaking, that when the company arranged funds from the investors, that is when they issued the debentures or they issued the preference capital, then their need can be for a specific period, for 13 years, let's say, or because we assume that the company is a going concern, So the company believes that some part of the total funds required will always be financed either through preference or the debentures, and hence that part of their total debentures or the total preference capital will never be repaid. It does not denote that the person from whom the funds are arranged will never be repaid, but it implies that if somehow some person who has provided debentures in the beginning wants the repayment, then they will be taken from someone else and then repaid to him. But from the company's point of view, that portion will always be never to be repaid, that is irredeemable. So when we use this word irredeemable and redeemable, then the common perception with the students is that in the case of redeemable options, or we should say in the case of redeemable debentures or the preference, the company will repay such debentures or such preference capital after a few years. And they believe that in case of irredeemable case or redeemable debentures and preference shares, the company will never repay such finances. But that is not the case, because it is seen from the perspective of the company and not from the perspective of the investor. So actually what is happening here, that part of the company's total funds which are financed either through debentures or through preference capital and which are never to be repaid for the whole life of the company will be known as irredeemable, and those which will be required only for a particular years, and after those needs are fulfilled, such debentures or the preference capital will be redeemed. It means company will no longer require such funds, and those denotes the redeemable investment options. So in this case, what is happening, that company has taken money on a particular date, let's say year 0, and then each year the company is going to pay the returns for infinite period, because company is presumed to be for a going concern. So either it is a PD or it is I, it is being repaid for the whole life. And because I said that in normal cases such fixed incomes are equal, so in a way it denotes equal payment for infinite years. And from the concept of time value of money, it denotes perpetuity. So what is happening here, that a issue of debenture or issue of preference capital which are of irredeemable character creates a perpetuity of outflows for the business, and vice versa a perpetuity of returns for the investor. Similarly, when we talk about the redeemable, then a company has arranged the money in the beginning and there is always a fixed maturity period. So that maturity period, if denoted by n years, then there will be each year payment, that is PD1 oblique या I1 जो भी केस है for n number of years, so it will be PDN oblique IN. Why I am saying? Because when I will customize the valuation or the returns for preference and the debentures, then for preference I will be using PD and for debentures I will be using interest. But because in this session we are covering the generalized concept, therefore I am writing oblique, so that we understand that these concepts are common which will be applicable for both the preference and the debentures. So the interest or the preference dividend, that is the returns to the investors, will be repaid each year for n number of years, and once these years are completed, that is the bond or the debenture or the preference comes to maturity, then there will be redemption. There will be redemption. Redemption that will be after n years. There can be a special case also, and that special case normally happens with debentures, and not normally. I am not saying that it cannot happen in preference, but normally it happens only in the case of debentures, that there is a multiple redemption. So it was a terminal redemption, and there can be multiple redemption. For example, a bond of 1,000 rupees can be redeemed in 5 equal installments. So there are not multiple redemptions, there are 5 redemptions and they are equal. तो R3, R4, R5, R1 से लेकर R5 तक ये सारे इक्वल हैं. इसका मतलब हर बार आपने 100 रुपये के 1,000 रुपये के डिवेंचर पे 200 रुपये रिडीम करे, प्लस हर साल आपने क्या पे किया, इंटरेस्ट. And these interest will be different because the principal is changing each year. For example, अगर ये 8% बॉन्ड थे पर एनम के, तो पहले साल में 1,000 रुपये पे इंटरेस्ट 8% के हिसाब से 800 रुपये पे हुआ, तो सॉरी 80 रुपये पे हुआ. तो इफेक्टिवली कंपनी को 200 रुपये रिडेम्पशन के और 80 रुपये इंटरेस्ट के देने पड़े. In the second year, 200 will be redeemed from the 1,000. 200 will be redeemed for the 1,000. It means what has happened कि आपने अब जो इंटरेस्ट पे किया है वो सिर्फ 800 पे पे किया है, तो ये 640 होगा. तो हर साल जो आपका इंटरेस्ट है वो कम होता चला जाएगा. जैसे कि अब ये आगे जाके 480 होगा, फिर ये, और क्योंकि हर साल आपका 160 रुपीज़ कम हो रहे हैं, तो ये दोबारा से 160 कम हो जाएगा, तो 320 हो जाएगा, और फिर ये 160 हो जाएगा. तो इंटरेस्ट की फिगर हर बार कम होती चली जाएगी. तो जब ऐसे केसेस होंगे तो यहाँ पर हम कंसाइज फॉर्मूलों की जगह ऐसे केसेस में जो इंटरनल रेट ऑफ रिटर्न है उस फंडे को यूज़ करेंगे, एंड दैट विल बी डीम्ड एज द एक्सपेक्टेड रिटर्न फ्रॉम सच इन्वेस्टमेंट्स. So we will be carrying on with the valuation or the returns calculation part of preference capital and debentures in our future sessions on fixed income securities. And this session 1 was created just to make you understand the basics that will be used in all this scenario. On this platform, this is Deepak Gupta signing off, and I hope to see you in future when we undertake in days to come